All right, everyone. All right, everyone. I'm going to start a series where I go over the tape reading chart. These were charts that Wyckoff did. Let me see what he said. All right, the following six chart studies were written by Wyckoff, and anyway, these are just tape reading charts, and as you can see, he did it. This was done by Wyckoff. It's not done by his understudies or anyone like that, but rather it was done directly by Wyckoff. And this is real Wyckoff. That's what I'm trying to illustrate. And also, I find that there's a lot of benefit to understanding this type of chart. Like today's chart would be the footprint, but I think there's to be able to consolidate volume at price instead of tick by tick by tick, but to consolidate it for like 10 ticks is much more practical, because you cannot read tick by tick, but you can read if it's consolidated, and we can build those charts today. The technology is available to do that. Anyway, so I'm just going to go over this chart. This chart, some of his studies, have to kind of read between the lines because he's just not very overt. So someone who has that background is better able to explain it. Otherwise, you're just gonna figure out like, what is he saying? So anyway, I'm gonna go through all of this and explain it. So this is the first study. There's gonna be 6 of them, and they're short. So I'll try to do one a day or one every other day and be done with it. All right. The idea here again is not to just just learn Wyckoff or just do analysis all over the place. The point here is to be sensible and practical and add it to your trading arsenal. For example, I have this chart of the ES. This chart just showed 113,000 traded and a break, right? Also on Friday, I think, what was it, Friday? You have this breakout over here with 6,000 and 20,000 over here. So this is where it initiated to break out, and then it retested, and then it went. And so this is very practical. I'm taking this chart, you see, that Wyckoff did, and building it out just like a tape reading chart. This is it. But I just have some indicators to help guide me because I want to focus on key behaviors and not read every single print. And then it becomes very practical and not just doing analysis for the sake of analysis. If this is one of the biggest problems that you see with the Wyckoff approach, or the Wyckoff folks who teach Wyckoff, is they get lost in the analysis because there's too much analysis. There's point and figure, there's all these sectors and groups, and then the indexes, and then all of these behaviors. You're going to get lost in the analysis. And then on top of it, a wave chart, and how do you read volume? Is this effort? Is this something else? Is this range accumulation, or is this just a range? So it's very important to know how to use Wyckoff in a practical way. And I say that and I harp on that because I've seen a lot of stuff online that, if you have a point and figure chart for the last 8 years trying to do an 8-year projection, maybe you got to ask yourself, am I actually going to trade it? It's common sense. So it's an academic and totally useless exercise, in my opinion. So anyway, so let's get to it. This tape reading chart begins at 2:30 p.m. on June 1st. with the stock at 86.30 and 3/8 on a downward swing from the previous day. All right, so this is here, all right? It's right here, and it's going down. And he took a short position. He kept the overnight short, and it's going. All right, the chart shows that there is little support for the stock. How do you know? It keeps on going down. No base building. All right, again, no base building. It just breaks support. It doesn't hold. If it holds, you would have a base, because tap once, tap twice, tap 3 times, you would have horizontal formations. But that's not the case. It may be assumed that the trader has a short position and carries it overnight. Okay. On June 2nd, the stock opened with 31,000 shares. Where is that? So right here, open on June 2nd. So this was the close on June 1st. It gapped down and then opened on June 2nd. All right, and it gapped down. There's not a great deal of stock pressing in the market, but there seems to be a lack of support. Why? Because it's a gap down, and there's 2 rallies of an 1/8 point each, and these each are the only ones that take price, are the only ones until price hits 83 and a quarter. So there were some very minor rallies. I think he's talking about this right here, until price goes down to 83 and a quarter, which is 83 and I think up to here. This box, this area. All right. Then there are 2 rallies of a quarter each, and a line indicating slight hesitation at 83 3/8. So 83 and 3/8, 81, 2, 3. So this line over here, all right, it's just base building. There's sideways movement, so there's some hesitation. The hesitation is because of the sideways movement. Another decline occurs to 82 and 7/8. So 82 and 7/8 is 1, 2, 3, 4, 5, 6, 7. Right here, that's the low. And a 3/8 point rally occurs. Where's the 3/8 point rally? It's this. That's the rally. That's the biggest rally out of all the rallies. On the way down, this is the biggest one yet. Very important, because as you know by now, the big rally from the bottom needs to be examined to see if it's a change of behavior, right? You have a stock that goes into oversold, keeps going down, and then you have this big rally. You need to see and examine it to see if it's a change of behavior. The trading zone is now confined to the 3/8 between 82 and 7/8 and 83 and a fourth. All right, so he's just talking about this right here. All right, he's talking about this area now. The stock begins to have a little support at this level. 1,000 shares are taken at 83. Very, very important. Again, this is accumulation. Why? Because now you have a rally, bullish indication because it's the biggest rally since, and then you have 1,000 shares here at the 83 level, another bullish indication. Why is it bullish? Do you see any print that is on an uptick that is 1,000 shares? No. That is why it's very important, because it shows that buyers are buying with size. Okay, that's why he's calling it out, but I don't know, for some reason he's not saying it's a change of behavior, or he's just saying he's just pointing out that a heavy buying has occurred, but he doesn't say heavy buying has occurred. He just says 1,000 shares are traded. But if you know, you can look and see that's the biggest volume there. 2 small dips occur on light volume. Right, so I think that he's talking about the 1 and the 4. With 1,700 100 at 83, all right, and 100 at 83 and 8, 600, and then 83 and a quarter. Talking about here. So this, again, the 1700 is heavy volume right there. That 1700 is heavy volume. And then after that, he starts talking about the 3, the 7, and the 6, which is the next line. You will notice also that after the heavy volume is here at 1,000 shares and 1,700, the next column is 300, and then I don't know, 700 and 600. These are above. These are at or above this heavy volume buying. That's also really important, because if it's accumulating, you shouldn't have price trading below, right? It should go up, not down. So here's the first time you have heavy buying at this level of support, and now prices are trading higher. So at and under 83, the transactions have totaled 6,300 shares. So he's profiling the volume at 83. This is volume profile. This is what he's talking about, is volume profile. When he says at and under 83, the transactions have totaled 6,300 shares, he's talking about this level and 82 and I think 7/8. And he's profiling and adding up the volume and saying it equals 6,300. This is one of the first times I don't know if it's the first time, but one of the times where you see Wyckoff actually using volume at price, which is what? Volume profile. He's doing that here and saying that it equals 6,300 shares from the 83 and below levels. The stock has twice refused to go below 83, and the sale at 83 and a quarter provides a bullish indication. All right, so let's take a step back here. Basically, in volume profile talk, this here would be some type of POC. All right, so the 3, 1, 10, 6, blah, blah, blah. All of this heavy volume here would be your POC for for the range. So you have a POC, which is the heaviest volume in whatever profile time you want to use, whatever distance or range. But this is the biggest at this 83 level. And if you combine it, it's like 6,300 shares. So he's putting it together saying at or under 83, the transaction has sold 6,300, not sold, totaled 6,300 shares. So there's a lot of transactions, and the volume profile is 6,300 shares, which is a lot of volume, big POC. Second, the stock is refusing to go down because it tried to go down twice. And third, you have a sale above the POC, above this 6,300 accumulated, above it. Putting that together, these three indications, he's saying that these are bullish indications, that this is bullish. Why? First indication, it's not going down. It tried twice, it did not go down. Second indication, the buildup of the most amount of volume across price at 83. Third indication, trading higher, above the POC or above this heavy volume traded at 83. Those three together are painting a bullish picture. All right, stops on any short positions should now be lowered, and a long position should be established if the price touches that figure. What figure? The 3/8. Okay, so he's saying that if it goes to 3/8, go long. Now you're gonna notice this, but what he's saying is you have bullish indication based on the three indications of volume buildup, inability to go down on two tests, and a higher traded price. Now he's saying if it makes a higher high, go long. All right, so where this 3 is the high that's established above the POC, and now he's saying if it makes a higher high, cover your short position and go long. So he's ready to go long on this breakout. That right there is a higher price and is a breakout. All right. When he says in a long position should be established if price touches that figure, making a higher high, go long. That means a double buying on stop of 83.38. One to close the position, the short position to close the short position, and one to go long if price touches 83.38. This covers the short and establishes a long at that price with a stop 1/4 under the low of 82.78. So all he's saying is you go long here and put your stop under the base, all right, where it refused to go down, put it under it. In this case here, where it says S, so he's going to go long here above this base when it makes the higher high, and he establishes the stop here where it says S. So he's ready to buy the breakout. All right, he's going to buy the breakout and put a stop. It's pretty far. It's pretty far, but it is, in a way, it's protected. You know, so because it's hard to, when price goes back, it has to fight against these guys at 1,000 and 1,700, right? So he made sure he went not only under that level, but under the extreme low by a quarter. So that's how he used stops, because he knows what he's doing. Look at everything that's in his favor. He has heavy volume across the 83s, 2 attempts to go down that fail, a high and a confirmation higher high, confirmation higher high, and then he establishes the stop. The other thing is, you'll notice that there's a cause. Again, there is a cause. He was big on this because the cause, if you have cause, you have a POC or you have heavy volume at the prices that are within that quote-unquote cause, within that trading range or within that line of accumulation, which is what this is. This cause or this accumulation line, he has that. This is favorable to him. This 83 here level has a lot of volume, and as it builds the base, it builds cause. So he has that in mind, and it has confirmation. The confirmation comes in the higher high. All right? And remember how he put a stop. He put it under the base, under the POC, or under the high volume area, the level of high volume. All right. All right, now it works in a quarter point range in small lots, except for 1,400 shares traded at 83.5. Is that 1,400 shares? which is this right here. So he's saying, oh, you got a lot of little volume, but there's good volume up here. All right. The support line is now 83 and a quarter. 83 and a quarter is, I think it's this. So now this is your support. Oh, 1 second. This is your line of support. You see, he's using that concept of a line of support. He does that with point and figure charts. All right. So, and the key word is support, right? So, I mean, you wouldn't go bearish unless it breaks that support line, just like it broke the resistance line up here above the 83 and a quarter. When it broke that, and then he decided to cover and buy the breakout. So similarly, he's now using line of support here. Okay, so stock breaks through the upside and makes 84. So he's talking about breakthrough, which is your breakout, and he's talking about this column. All right. The stop is raised to 83 and 1/8. Again, he's moving the stop under the base, the line of support. You see the line of support? It makes a line of support here. Then it does a breakout. What does he do? He moves the stop under the line of support. All right, basically 2 boxes under the line of support. He's going to do that again and again. You know, when he sees this, he puts it here. You know, sees that, it's 2 boxes under the support. All right, under when he identifies, he identifies a support, and then he identifies a breakout. Then he puts the stop 2 boxes under the line of support. It should also be mentioned that when David Weiss used to trade Renko, he would move the stop 2 boxes, 2 bricks back. Meaning, if he was long, he would put it under whatever price it was trading at, the Renko, he would put it 2 boxes, two bricks, the low of the 2 bricks back. Just a side note, anyway. The stop is then raised to blah, blah, blah. Sailing is now clear to 83 and 3/4. Then there is a small reaction to 84. Now, foods, then comes back down to 84. Support just above 84 is much stronger than pressure. All right. Basically, pressure is resistance, or resistance pressure. The selling dries up again. Where does it dry up? Well, you just look at the dips. All right. So this one is 8. This one is 4. I think he's talking about the 8 versus the 4. The selling dries up again, and the stock pops up to 85 and a quarter. Basically, he's talking about pops up, meaning breaks out and goes here to 85 and a quarter. Meanwhile, the stops have been raised to 83 and 3/4. At 83 and 3/4, there's little demand and a reaction sets in. A 5 and an 1/8 dip to 85 and an 1/8 is followed by a rally. All right, this formation above 85 does not appear to indicate any serious decline. So he goes above 85 and does not, the formation here is not any serious decline. A recovery of nearly 3 points calls for about a 1 3/8 reaction. All right. So this was the formation. All right, decline of nearly 3 points. But it fails 1/8 short of this, and the dip ends at 84. Ooh, so he's just talking about this formation. Not afraid of it. It declines here, makes a 1, 2, 3, this little bounce here, and then eventually declines. All right. So the one thing I'm trying to figure out here is that when he says a recovery of nearly 3 points, right, calls for a 1 3/8 reaction. Is he doing a count? So this recovery, right, is he doing a count across this line for it to go down? Because he says a recovery of nearly 3 points calls for a 1 3/8 reaction. So how would you do that? You would have to do the count. All right. So I think he's doing a count, but I'm not 100% sure. All right. But it fails 1/8 short of this. Yeah, this is, see, it fails or it falls 1/8 short of this, and the dip ends. So he did a count, which is a very key point here, because what he basically did here was he applied cause and effect to an intraday chart. Again, he applied cause and effect to an intraday point and figure tape reading chart. That I think that's really important, because a lot of folks think that point and figure, you have to, first of all, you have to have points, 82, 83, 84, 85. But over here, he's doing it on fractions. That's the first point, that he's doing it on fractional amounts. And the second thing is, a lot of Wyckoffians think that it can only be done for swing trading. But here, this is the evidence of it being applied to intraday chart. So, I mean, I hope I'm not reading it wrong, but that's what he says. A recovery of 3 points, that's your LPSY, by the way, that you do the count, the resistance line. The recovery of 3 points calls for a 1 3/8 reaction, but it fails to go 1 3/8 and only goes 1 2/8. So he must have done a count. And the dip ends at 84.12. All right. Pressure on this decline is neither light nor heavy. It is normal reaction. This is selling pressure. The reaction itself wears out and demand overcomes supply. The stock soon sells above or trades above 85 and continues straight up. This is a new high ground. Right? The trader should raise the stop to 84.25 and wait for further developments. The 1600 shares at 86.5 brings a 3/8 dip to 200. Again, the 1600 shares at brings a 3/8 dip to 200. So let's examine this at 86.5. So it's just up here, the little climactic action right here. Right, that's what he's talking about. That's like a minor. Those are minor climaxes. So by minor I mean just in that one little brick, and it's a high volume, and because of that you have a dip. All right, the 1600 shares at 86.5 bring a 3/8 dip to 200. On the next upswing, there's a surge and the stock only gains 3/4 a point, with 500 shares trading at 86 7/8. All right, the upward thrust are shortening. This indicates an impeding reaction. So this is one of the first times, I don't know what, this is a time when he mentions one of the key behaviors, which is shortening of the thrust. So he's mentioned climactic action of the 16, but without saying it's a climax, just saying that this heavy volume has caused this pullback, right? And then he mentions that this next surge up has lower distance from high to high, meaning from the 16 of the prior rally high to this high, the distance has shortened. And he's watching that and he's saying that there's an issue. What's the issue? It indicates another impeding reaction. Consequently, the stop is moved to 86 3/8. Where's the 86 3/8? He rallies it up over here. Adding the sales above that figure, it is noted 10,000 shares have come into the market at this level. Again, another indication of the volume at price, saying it is noted that 10,000 shares have come into the market at this level. This is volume at price. This is volume profile. Okay. As it is the last hour of trading for the day, the tape reader may decide to sell at the market. If he does not, the stop will be caught. Okay, so there you go. I've completed the study, and I'm going to point a couple of key things out. All right, I know Wyckoff for some, this is just, I guess he just doesn't go into the minutia, but the point that he's making from the open is that, hey, it closed on the first and then it opened on the second. Then what happened? Weak rallies. How do you know? They're little bounces. Over here, there's some base building, but then after that, it pukes. After it pukes, right, you have a very important indication, a couple of indications. The first is the biggest rally in the downtrend that establishes a high. The second indication is 1,000 shares on an uptick. All right, that's a bullish indication. So you could call either of them a bullish change of behavior. But if you're looking at volume, then this 1,000 is the bullish change of behavior on an uptick. If you're looking at price movement, then this rally here is the biggest rally in a lot of rallies, and that's the big change of behavior. So both are actually valid. Both are valid. Just a matter of whether you're using price or volume. Then he mentions the inability for price to go down, building the base, and then another heavy print of 17, more accumulation. Finally, he mentions this high, which is an equal high to the prior rally high. And then after that, he notices a key thing, which is volume profile or volume at price, and that's that a lot of volume has traded at a particular level where the 1,000 shares and the 17,000 shares have traded, or excuse me, 1,700 shares have traded, indicating a line of accumulation. All right, accumulation, base building, and finally the higher high. Once that higher high is established, he gets out of the short and goes long. Why? Because of three indications. One being the line of accumulation, two being the inability to go down twice, and the third being a higher high above that accumulation heavy volume line of support. And then he takes the long position and covers his short. What he does with the stops, he looks below the base, and 2 boxes below the base is where he indicates his stop. All right, so I think I've covered all of that. After that, it just goes sideways, etc., and then finally breaks out over here and does a lot of other things. And he's just moving his stop. Again, notice the line of support is what the key thing he mentioned. He's watching the line of support, which means he's watching the line of resistances, right? So he's watching the line of support here, watching the line of support here, moving his stop, typically two boxes below after the breakout. All right. After that, it goes up to this area and pull back some, and then it breaks out. He has a stop here. 2 boxes below, you have your breakout. Then again, it comes up here, and this is where it gets interesting, because after this breakout and this higher high, what you have is some cause. And what happened is it pulls back and retests, making a line across this level. I think this is 84 and 1, 2, 3, 4, 84 and 5/8 or whatever it is, right? And that gave a projection to him. It went to that projected level, missed only by one box. Okay, and then after that, it picked up, and there was a very strong up wave. This is the biggest up wave out of all the waves. What do you know? Although it's not mentioned overtly, we know that this is climactic. Right? We know that this is climactic. Why? Because it's the biggest up wave on top of a trend. What else do we note? That on top of it, you have very high volume. What do you know about volume at the top of anything? It's climactic, right? Because higher prices are better prices for sellers. All right. As it does this, he has his stop here. And then finally, when it makes the next surge up, right? And I haven't totaled all the volume on this, but there's a surge up, and the behavior that he mentioned is shortening of the thrust after this climactic volume made or led to a 3-bar pullback or a three box pullback. It made a higher high with a shortening of the thrust and started going sideways, building volume sideways, and he was concerned because of the shortening of the thrust, saying that is telling me that there's an impeding reaction, so let me move my stops up here. So the key behaviors that we want to point out from this, I have a text tool here. Anyway, the key behaviors are your change of behavior, right? Change of behavior meaning the heavy volume prints, as well as the biggest rally. That's important. The second is the base building. The third is the volume across the line of price. The fourth is the higher high. The fifth is how to move stops below the support line of support by like 1 or 2 bricks. What's it? The sixth is important because he used cause and effect here to determine how much the reaction would be. The 7th is the climactic volume, and the 8th is the shortening of the thrust, right? And if you want a 9th one, it would be the volume across this base, because it starts base building here. All right, folks. So that's the study, and if you want, you could go look at this. This is available. This is Division 2 of the Wyckoff course. It's available, and just follow along. All right. Take care. Bye.